Knowledge is a part of what I call cash, and I got this from my mentor. It's not C-A-S-H that's important. It's K-A-S-H, and that's knowledge, attitude, skills, and habit. That's how you can lose money all the time, right? But if you have those four things, knowledge, attitude, skills, and good habits, good habits, then money is no object, right? That's what intelligent wealth is. It's the lessons, the stories, the insights that get passed down. Who are your family heroes? Right? Now think about it. As trillions of dollars move across generations, what good is a transfer if we don't transfer wisdom too? And I go back to the Genius and the Clarity Act. It's already shifting how financial institutions operate, moving us closer to digital systems, transparency, and new rules of money. The family who understands not just dollars, but the rules of the freaking game, understand the game, will be the ones who protect their wealth. Now, hat tip to Anthony Paplona, who sat down with Darius Dale, founder and chief executive officer at 42 Micro LLC. And he's also a financial media contributor. They sat down with them and they were talking about economic regime analysis, inflation target, and investment strategy recommendations. And this is what I really want you guys to hear is the investment strategy recommendations. Talk about the traditional 60/40 portfolio and says it's outdated. Listen up.
That's going through this regime change and there's structural inflation that's higher than what it previously has been.
Yep.
Let's talk about portfolios. You guys have been pretty clear now for months that people should have a very specific type of portfolio to prepare for and to benefit from that structurally higher inflation. Talk through the portfolio construction that you guys are talking to your clients.
Yeah, that's a great question. I'll pivot a little bit. Sadly, it's not that the portfolio is designed to benefit from structurally higher inflation. What our K.A.S.H portfolio, which is risk managed, 60% stocks, gold, and Bitcoin, it's really designed to take advantage of the fact that the I guess the traditional ballast of defense and investor portfolios in this kind of 60/40 world we're exiting, the Treasury bond is no longer the defensive asset for a variety of reasons. In our view, it's a melting ice cube of an asset. Now, we're not calling for a meltdown of the Treasury bond market or some big financial Armageddon. Don't make any headlines here. This is actually quite boring stuff. But the reality is, from an institutional asset allocator perspective, its correlation to stocks and bonds is no longer favorable from the perspective of playing defense. And so ultimately, and part of the reason for that correlation is because there's just, for all the reasons we talked about in terms of supply and demand dynamics. And there are other supply and demand dynamics that we should unpack too. So for that reason, it's highly unlikely to have the same defensive properties in an investor portfolio as it used to be. So that means you have to find another way to play defense. The way we decided to play defense, and that served our clients quite well over the past few years, is rotating that bond allocation out of your 60/40 portfolio and replacing it with gold and Bitcoin. Gold is an instrument that essentially allows investors to outrun the financial oppression that we're likely to eventually see as a function of the structural regime change of the Fed. And obviously, Bitcoin is likely to help investors to outrun the monetary debasement that we tend to see in these fiscal dominance regimes. And again, this is not a U.S. phenomenon. This is something that's been happening for thousands of years around the world.
Hear that, right? We really have to pay attention and learn that the game is changed, but learn that the game has changed. Learn the new rules of the game. I mean, some of us don't know or didn't know the old rules. So what he's talking about, bonds. Usually bonds was a way to hedge against what was a route to safety. And because of the debt, and because um the real push to lower the interest rate to ensure that we do not pay exorbitant. We don't have exorbitant debt payment. So we're kind of stuck between a rock and a hard place. And the goal is to, because right now, we're monetizing the debt where we're paying more, and our debt payment is not almost, it's more than our military spending. We have to get that lower. Hedging to gold and Bitcoin is one thing. If you find, I'm just giving you information, not telling you what you should do, other than get your education, learn. For me, my hedge is crypto and also my life insurance policy, right? Because once that money start flowing in, because you notice he didn't say hedge against the market. He said hedge against bonds. Because once that money start flowing, once the dollar is gets cheaper, the money is definitely going into the market. Well, I'm not saying definitely. I'm not an investor, but traditionally that's what happens. When we start devaluating the dollar and printing more money, that money usually historically goes in the market. Now, with life insurance, especially one that's pegged to the market, not in the market, you're not going to get all of those gains, but you're not going to lose in case there's a blow up, right? So that's my strategy. That's all of it.